Level 1. Tom has $0 in his bank account. The worst part isn't being broke, it's how the bank treats him. Tom walks into the bank, sits down. The bank teller is polite, hands him a folder. What Tom doesn't know is that before he said a single word, the bank system already read his balance. 0. That number placed him in the lowest tier automatically. And that tier decides everything: what he gets charged, what rates the bank shows him, what bank products get offered, not his job, not his history, just the number. The folder has a monthly bank maintenance fee buried in it, $12 a month, waived only if his balance stays above the bank's minimum threshold. His balance is 0. The fee starts immediately. 2 months pass, $24 gone, no product, no service, just a penalty for not having enough money to avoid the bank's penalty. Tom calls the bank. 9 minutes on hold. The bank rep confirms the fee is valid per the account agreement. Tom pays it. At 0, the bank is not trying to keep Tom. It is charging him a fee for existing at the bottom of its tier structure. Level 2. Now Tom has $10,000 in his bank account. Same bank, but completely different experience. The monthly bank maintenance fee disappears without a single phone call. Tom never asked, never negotiated. The bank system read his new balance, crossed an internal threshold, and removed it automatically, which tells you everything about how the bank actually operates. It was never a policy, it was always a number. The number changed, the bank's behavior changed instantly. But here is where the bank starts making serious money off Tom in a way that never appears on any statement. The bank pays Tom around 0.5% on his savings. That same deposit gets lent out by the bank at 7 or 8% to other customers through personal loans and auto financing. Tom earns roughly $50 a year on $10,000 sitting in the bank. The bank earns multiples of that using his money. That spread is the bank's most reliable source of income. It is disclosed nowhere in any document the bank has ever handed him. And the bank's overdraft system is still fully running. 9% of all bank accounts in America pay 79% of every overdraft fee the banking system collects. Paycheck deposits Friday. Bank processes the auto payment Saturday. Transfer posts Monday. Bank charges the overdraft fee Sunday night. $34 on an $11 gap. The bank does not call, does not flag it, does not warn. It runs the fee through its system and sends a notification after the money is already gone. The Consumer Financial Protection Bureau found that bank overdraft fees cost Americans around $12 billion a year, not from overspending, from a bank system that is specifically designed to profit from timing. Level 3. Today, Tom has $100,000 in his bank account. The bank sends a letter, not a standard bank notice, a different kind of correspondence entirely. Preferred customer, valued relationship, complimentary bank portfolio review. Tom walks into the bank. This time, a bank advisor meets him at the door, leads him into a private room. Door closes behind them. First time in every visit to this bank that has happened. The bank environment feels different, quieter, more deliberate. Tom sits down, thinking the bank has finally changed how it sees him. His balance crossed an internal bank threshold that moved him into the cross-sell tier. Below that number, the bank loses almost nothing if Tom walks out. Above it, Tom is worth pursuing for bank investment product fees, insurance referrals through the bank, and premium bank credit products. That private room is not the bank building a relationship. It is the bank running a revenue conversation in an environment engineered to feel personal. Tom walks out with 2 new bank products: a bank rewards credit card sitting at 24.9% APR and a bank-managed investment account charging 1% of his balance every year. The bank advisor never pushed. The room felt serious and considered. Tom never challenged the terms because the bank environment made hard questions feel unnecessary. 1 month, Tom carries a balance on that bank card. That single month erases nearly a year of reward points the bank had been accumulating for him. The 1% bank advisory fee pulls $1,000 out of his account that year, regardless of whether the bank grew his portfolio or not. Neither number appeared in the bank brochure. Because the bank brochure is not a disclosure document, it is a conversion document. Level 4, Here, Tom crosses $500,000 held across his bank accounts. This time, the bank makes the call. Not someone from the bank's front counter, someone from the bank's wealth division. Different voice, different preparation. Asks Tom what his financial goals are before the bank mentions a single product. Tom feels the difference in how the bank is now speaking to him, like he is being listened to rather than processed. His bank credit card APR quietly drops from 24.9 to 19.9. Tom reads that as the bank finally acknowledging years of loyalty. What the bank actually did is run his updated balance through a risk pricing model and move his rate category down one tier. The bank did not do that because of the relationship. The bank did that because an internal algorithm recalculated his default probability and adjusted accordingly. Tom has never once been shown which bank tier he sits in. That bank tier has been determining his costs since the day he opened the account. At this balance, the bank is also sitting on a detailed financial profile of Tom built entirely from his own bank activity. Every paycheck that hit the bank account, every bill the bank processed, every month his bank balance ran low, every pattern across years of transactions. The bank has mapped his financial behavior more thoroughly than almost anyone in his life. That data is not being used to give Tom better bank terms. It is being used to identify the precise moment the bank can introduce the next product with the highest chance he says yes. Level 5. Now Tom crosses $1 million in combined assets held with the bank. The bank assigns him a named private relationship manager, not a general bank rep, a dedicated person whose entire role is managing Tom's relationship with the bank. Tom has not been placed on hold by the bank once since this person appeared. Bank fees are cleared before Tom ever receives a notice. Walking into the bank now feels nothing like walking into the bank at zero. His bank relationship manager brings up something over a meeting that Tom has never heard mentioned in any previous bank conversation: a securities-backed line of credit. Tom can pledge his investment portfolio held at the bank as collateral. The bank lends against it at 6.2%. The portfolio stays invested and keeps compounding while the bank loan runs. Tom gets full liquidity without triggering a single asset sale. No capital gains tax event, no disruption to the bank's management of his portfolio. His old bank credit card is still open, still sitting at 19.9%, untouched for over a year. That gap between what the bank charges him to borrow on a card versus what the bank charges him to borrow against a portfolio is not a rate difference. It is a wealth transfer mechanism built into the bank's product structure. The customer borrowing from the bank at 6% builds net worth while the loan runs. The customer borrowing from the bank at 19% loses ground on every dollar borrowed. Same bank, same institution. Two completely opposite financial outcomes produced by one product decision the bank makes based entirely on balance. His bank manager walks him through a strategy the bank makes available at this tier. Buy, borrow, die. Accumulate assets inside the bank. Borrow against them at the bank's low private rates instead of selling. No capital gains tax triggered while alive. At death, the tax liability on embedded gains disappears through a stepped-up cost basis that resets for the estate. Tom had been paying capital gains tax on every realized position every single year before this bank conversation happened. The bank had access to this strategy the entire time Tom was a customer. The bank does not introduce it below a certain balance. Level 6. Finally, Tom holds $10 million in assets with the bank. He walks into the bank and his name is known before he reaches the desk. There is no hold queue, no bank fee notices, no standard bank folders handed across a counter. The bank's private division coordinates tax attorneys, estate planners, and specialist advisors, all operating under the same bank relationship. Bank lending terms at this level are not assigned by an algorithm. They are negotiated directly. Bank investment access exists here that the bank does not make available to any tier below this one. Here is what the entire progression actually is. The same bank system that charged Tom $12 a month for having nothing is the exact same bank system now managing $10 million for him. The bank never changed its nature. The bank only changed which version of itself it showed Tom based on the number it was reading. Every document the bank handed Tom at every stage was a bank pricing document. The bank welcome folder at 0. The bank preferred letter at 100,000, the bank wealth materials at 500,000, the bank estate documents later. None of them were written to benefit Tom. All of them were written to extract from Tom or sell to Tom at whatever margin his bank balance permitted at that moment. The distance between absorbing $34 bank overdraft fees and borrowing at 6% against a growing bank portfolio is not intelligence, not character, not financial discipline. It is the number the bank system reads when it decides which version of itself to show you. Most people move through their entire financial lives being priced by the bank's tier system without ever knowing that system exists. Now, you know it exists.